Hello, everyone, and thank you for joining us today. My name is Kyle Bell, Knowledge Exchange Coordinator with Farm Credit East. Before we get started, I'd like to offer a few technology tips to keep in mind while viewing today's webinar. All attendees are muted throughout the presentation. Once in a while, it's a good idea to tap your mouse so your screen does not go to sleep during the presentation. There will be time for questions and answers at the end of the presentation. Questions can be text chatted in at any point during the presentation. To send in your question, click on the question mark button on the right side of your screen to expand the question box where you can type in your question. A recording of today's webinar as well as presentation materials will be available at farmcrediteast.com/webinars, as well as our YouTube channel for access after the webinar. Before we get started, just a simple disclaimer saying all this information is presented in good faith and should not be intended for investment, tax, or legal advice, just as our legal department would ask us to say. So our featured presenter today is Dr. Chris Wolf with Cornell University. He is a professor of applied economics and management. So Chris, I will make you the presenter so you can share your screen.
Okay, let me see, hold on. Is that working for you, Kyle?
Yes, it is. We can see your full screen.
Great, thanks a lot. Thanks for having me, everyone. It's nice to talk to you. I guess it's afternoon, yes, just barely, this afternoon. So I'm gonna talk a little bit about the US dairy situation outlook for 2023. I think it's a year that just has a whole lot of uncertainty around it, but let's talk about some of the things that are related to that. So I want to start a little bit by reviewing kind of 2022. We're starting to look at the farm business analysis summaries from 2022, and the milk prices in 2022 were kind of pretty spectacular by historic standards. So this is the class 3 price. In red is 2022, and we hit 25.21 there in May of 2022, and the average for the class 3, which of course is milk that goes into cheese and dry whey, and a primary driver, as it's the biggest use of milk in the United States, almost $21 a hundredweight. And historically we'd say, wow, that's a pretty spectacular price, and would be if we didn't have the high kind of feed cost to go along with. The other thing that kind of jumps out to me about this graph right here is kind of the massive amount of up and down that we had in 2020, which is that green line there, where we had the big drop there when COVID hit, and then when the government stepped in and bought a pretty large amount of cheese for the Farmers to Families Food Box program, we had a spike in price there, and then they kind of did it again in the fall months. But without considering feed prices, you certainly looks like a pretty special price there in 2022. And in fact, the class 4 milk price, which is, and again, class 3 and class 4 are both national prices, and to a large extent international prices, because we trade a significant amount of dairy products. But class 4 is milk that goes into butter, and the co-product there is non-fat dry milk. And class 4 prices were way above where they had been historically, and averaged almost $24.50 and hit almost $26 in the middle of the month, or sorry, the middle of the year. And so that was kind of a spectacular price, and just reflects really fundamentally how tight the butterfat markets have really were in 2022, with increased consumption, not just of butter, but of different creams and of whole fat products of all different types: yogurt, ice cream, beverage milk. So on the milk price here, it was pretty good, and the resulting New York mailbox price, just for comparison, and there's always a lag, by the way, so October is the last month that was available. The New York mailbox milk price, which is U.S. Department of Agriculture's attempt to proxy what actually ends up on the milk check, you can see is over $26 in the middle of the year there, and is on pace to be 25 something, although it's going to drop off when the November and December prices come in relative to the prices that are on this graph, but still well above where we had been in recent years from a milk price perspective, and not just in this part of the country, but all over the country, and in fact internationally. And in fact, the U.S. all milk price, and this figure goes all the way back to the 1980s, we hit an all-time high in May of 2022 of $27.30 a hundredweight. And the all milk price is correlated with the mailbox price. It's not exactly the same thing. The all milk price does not, for example, have hauling taken out or promotion. So it tends to be higher than what actually ends up on the milk check, but still quite a high milk price. The other thing that kind of stands out about this figure is you could see that we used to have some seasonality back in the 80s and early 90s, and then as the price support program went away, then we really started to see some, there's still some seasonal movement in there, but a lot more volatility and moves that were $3, $5 a hundredweight or more, sometimes from month to month, and just an increasing amount of price risk that we've seen in the milk price as we got away from price support and moved into more of a market-based and more dependent on international prices. U.S. milk production then for 2022 ended up flat kind of for the year. So up 0.2% for the year, year over year, 2022 compared to 2021. Trend increase in milk production is 1.5, 1.6, 1.7%. And so this is well below trend. Really kind of two stories that's going on here though. In 2022, in this graph is the black lines. And so the first half of 2022 was behind 2021 and the second half was ahead. So the black line is up below the red line in the first half. And then those high milk prices, you started to see a response. And so, in fact, if we had, halfway through the year, we were below, like 0.7% below where we were a year earlier. And then we finished above 0.2% because we were over 1% higher in the second half of the year. And so, partly a response to those higher prices and also, probably a lot bigger response if we didn't have some of the base programs that are applying, especially in this part of the world. And New York milk production then ended up 0.8% year over year. So, and the same story as the national one, kind of lagging behind and not much growth in the first half of the year, and then growing a little bit in the second half of the year to be up 0.8%. Nationally, we finished the year with 9.4 million milk cows. And when you look at this graph, you got to keep in mind the vertical axis scale there, because it only goes from 9.37 million to 9.42 million. So but we built the herd a little bit in the beginning of the year, and then even though milk production went up in the second half of the year, we were kind of cutting back a little bit on the national milk herd. This is weekly dairy cow slaughter for 2021 in blue, 2022 in orange, and then the gray bars are the first 4 weeks of this year. And I bring this up to point out that the culling has been higher in the first 4 weeks of this year than we had been. Definitely much higher than we were in 2022, and even higher than 2021 to some extent. And remember, 2021, we were kind of cutting back to begin the year. So that would indicate that things have maybe gotten tighter and we also don't have a ton of heifers. Although, quite frankly, I think we've proven in recent years nationally that we don't need that many heifers. The dairy farmers have gotten a lot better at raising the heifers that they want and need to have as replacements. And, by using, for example, sex semen to get the replacement heifers out of the cows they want, and using the beef semen on the other cows, and which produces a steer that sells a lot better. And so if you look at the national numbers, you'll see that we don't have that many replacement heifers. 45 replacement heifers per every 100 milk cows, but that hasn't really held us back in recent years. So I think if there were the ability to expand, I think you'd see milk production increase at a pretty decent rate, or at least it certainly would have been the last 6 months. It's a little bit spotty, kind of as always, about where the milk production growth has taken place. And it's really Texas is the kind of the one that really stands out, and to a lesser extent in percentage, but definitely in percentage terms, South Dakota and even Kansas increasing for 2022 over 2021. And Texas is, big expansions, big new plants there that are taking a lot of milk in. But even Texas was pushing their ability to process their milk here last year, and to the point where they got the spot markets were getting lower, and they were having some issues with balancing. Texas is the finished the year of 2022 as the fourth biggest milk producing state. So California is 1, Wisconsin's 2, Idaho's 3, then you've got Texas and then New York. If they continue to increase it anywhere near the pace they have been for the last couple of years, Texas will finish 2023 ahead of Idaho and be the third biggest milk producing state. So we'll see. New York kind of stands out on this graph here for December because the milk production was up in a relative sense over the previous year compared to the kind of surrounding states which weren't up as much. And then I've got up there in the corner, you can see the supreme alfalfa hay price, which is the USDA's kind of attempt to capture the dairy quality hay price. And you can see California, that's actually down a little bit at $3.90 a ton over what they had been earlier in 2022. The drought has really affected the forage prices out there in California, and it's affected the ability of the nutritionists to kind of balance those rations. They've been real extreme on having as little forage as they could in some of these rations and pushing the cows that way. Wisconsin is, half that price at $1.96 or $196 a ton for the supreme hay. New York has actually been coming up in price. It wasn't the best year last year for producing hay in some parts of the Northeast and New York, and so part of it is just reflected there in those relatively high hay prices. And so we could use a really good forage year going in, well, everywhere, but in particular in the Northeast this next year. So we'll have to watch the weather on that. This is the United States milk price in red, New Zealand's in green, and the European Union's in blue. And a couple things to keep in mind. First of all, when you look at the scale on this is in euros per 100 kilograms of milk at 4.2% fat. So that's not, you look at that, it says 47.80 for the United States. That's nowhere near, the farm milk price for almost anybody in this country certainly would be that level. So if you wanted to put that into terms that would be more familiar with what we were looking at, you'd want to divide it by like 2.2. 2.1, 2.2 to get you in the neighborhood. But the point of this figure is to see where we're sitting relative to the other major milk exporters. And certainly our biggest competitors when it comes to exporting dairy products are New Zealand and the European Union. And one thing that jumps out about this, if you look back over the previous 3 years, is first of all, in 2020 in particular, U.S. farm milk prices were way above the European Union and way above New Zealand. Another thing that kind of jumps out at this figure is just how much more volatility we've had in the farm milk price over time than those other two major competitors have had. But at the current time, the European Union is 20% higher farm milk price than we have in this country. And it's, by the way, showing up in some of their milk production. And New Zealand is, 12-15% lower in milk price. New Zealand tends to be lower. They are focused on exporting. They export a lot of powders, and they're the low cost producer, and so their farm milk price is not reflecting the fluid use and some of the other things that are reflected in our price. And furthermore, they're exporting 90% plus of their milk production, and we're exporting more like 20%. Still, that would indicate that, we're competitive at the farm milk price for the most part, and we'll get into that. The European Union milk production last year was like the United States, but even a little less, so down a little bit year over year for 2022, and that certainly tightened up international markets. Now, December, the most recent numbers that came in for the year, it's flat to down 0.1%. But December, it was actually up 1.1% kind of year over years. And that in part reflects this higher milk price, this climb in milk price here. And the incentive has been in Europe to, produce milk if you can. If you've got feed, if the fuel costs are not too high, to get the milk production out. And so in December, Germany is up 3.1% and the Netherlands up 4.1% over a year earlier. You have to keep in mind the year earlier was fairly low, so that's not huge increase, but still that's partly responding to those market incentives. Australia and New Zealand were both down in 2022 over they had been a year earlier. And Australia and New Zealand work on kind of the opposite marketing year than we do. They start in July and finish in June. Still, Australia down 6.7%, New Zealand down 3.1%. That's pretty significant considering that we are competing in the export market with them. And part of it is a weather deal. New Zealand was particularly hard hit by the La Nina. And another thing that's been going on with New Zealand is increased regulation on the environmental side. They have been trying to cut back on the cow density that they're putting out on their pastures and for environmental reasons, and that's showing up in the milk production. As a consequence of these competitors being down in milk production or flat, and we have had, the United States had an ability to kind of take more market share in the export market. And so this little graph by volume here shows how we've kind of been steadily climbing for about 3 years there. The lower part of the graph shows you where the exports went over the previous 3 years. Mexico is by a pretty significant advantage our most important trading partner. They're also the place where we send the most cheese that we export. So when Mexico's doing well and importing from us, that's a very good thing, particularly for the cheese. And as a side note, with the amount of cheese processing capacity that we have added in the last couple of years and is looking to come online nationally in the next couple, we're going to need to export cheese aggressively to kind of keep up there. China is the second biggest single country. The bars on the far right-hand side are Southeast Asia, but that's a combination of 9 countries there. So it's not, so Southeast Asia, very important, but it's 9 countries there. China, you can see 2021 was a pretty big jump over 2020 for what they imported, and then 2022 kind of kept that increase going. And if we look at US dairy exports data, sorry, this is a little blurry. I couldn't find a clearer, more high definition of this picture. The point here is that the total export value, so the dollar value that we exported in 2022 as a country for the United States is $9.6 billion, which is a 25% increase over 2021. But the milk solids that we exported were only 5% more. So we exported 5% more at 25% higher revenues from exporting, and which reflects the higher milk prices that showed up not just domestically but internationally. So it was kind of a stellar year for exporting for the United States, and you can see cheese exports up 12%, skim milk powder actually down a little bit, dry whey up 9%, butter up 43%, but the reason that the butter fat was up 43% was that we don't export much. So in a relative sense, we essentially mostly consume the butter fat that we produce here. So thinking about the milk price outlook for 2023, I want to talk about the demand side, and then I'm going to talk about the supply side. And as I mentioned earlier, there's a kind of a whole lot of uncertainty about what's going on in the economy on both sides right now. On the demand side, it's really all about US consumer income domestically and spending, which really means where's the economy going? Are we going to have a recession? If we do, is it going to be, a minor one like we had in 2020, which was very short-lived, or is it going to be longer terms? And then internationally, it's also about how the international markets are doing, how China's doing in particular, but where's international demand at? And then on the supply side, it's a question of feed costs, which have been high. Are they going to stay high? What's the feed situation? How much are the farms going to be living in the cash markets? And then that also relates to weather and where we are sitting for dairy stocks. So let's kind of get into those topics. So just general economy. I mean, as I'm sure you all know, right, all we've been talking about is inflation and the Fed's trying to get that under control. And what's that doing? And is that going to tip us into recession? We are sitting at an unemployment rate of 3.4% for January, which is, we've been hovering in that neighborhood. We were in that neighborhood before the pandemic hit, and we're kind of back down in that neighborhood. Historically, If you're an economist, we always said that 5% was full unemployment because there was always, or yeah, 5% unemployment was full employment because there was always at least 5% of the people that, you know, were frictionally unemployed between jobs or had, you know, things of that nature. So by that definition, 3.4% is certainly beyond full employment. It's difficult to imagine having a recession when we're, you know, so fully employed. But if we look at, dig a little deeper, right? Remember, the definition of unemployed means that you have to be looking for a job. For example, if somebody was out of work and they stopped looking, they would no longer be considered unemployed because they wouldn't be in the workforce. So it's, I think, useful to take a look at this employment to population ratio, which is this graph right here. And you can see, first of all, that, you know, a significant portion of the population kind of stepped out of employment, right, due to the COVID, and not everybody has come back. So, you know, we were at 61%, 61 point something percent of the population employed prior to COVID. It dropped by 10%, okay? 10% here, but, you know, 20% in percentage terms. And then it kind of has come back slowly to where in January, we're at 60.2%. So we're still 1% below. And part of that is demographics and kind of an aging population, perhaps. And part of that is that some people that left the workforce, you know, maybe for health reasons or some other reasons didn't come back. But so we certainly have less people, less percentage of the population in the workforce. And so that's part of what's coming on. And if they came back in, you know, and were looking for a job, then that would, you know, maybe help out some of this employment situation. Right now, there are actually, I believe, 2 job openings for every person that's looking for a job, which is a historic high. So, you know, to the extent that businesses are looking for a job and can't find anybody, it's I guess, a little bit unsurprising. Unfortunately for agriculture, that tends to be even a more extreme situation in the rural areas than it is in the urban areas. And, you know, part of the question in some of these places is, are there just enough people living in rural areas to even fill the jobs that we have? And that's a longer term kind of policy discussion that I think we need to think about. So the story has been inflation. This is why the Federal Reserve increased the federal funds rate, the interest rate, 7 times in 2022 and once so far in 2023. If you look at inflation, is kind of a mixed story, I think here. That's pretty clear from the data that have been coming in. 6.5% in December, 5.7% if we exclude food and energy. The Federal Reserve, when they look at it, right, does the core inflation without food and energy. In fact, this is one of the key factors that they're looking at is personal inflation and personal consumption expenditures without food and energy, right? Because food and energy tend to be more volatile, and you don't want to overreact to increases that are short term in fuel prices or something of this nature. But 4.7% in December is well above the target rate, which is 2 to 2.5%. You know, there are indications that especially a lot of the goods markets are having inflation is relatively under control in a lot of the goods markets, and housing has been a big one that maybe looks like it is turning downwards and will help that. But still, 4.7 is a heck of a long ways from 2.5. And you know, there are some economists that I've heard that have been saying, well, you know, really maybe that 2.5 target is just too low, and maybe it needs to be higher. As far as I can tell from my reading, the whole argument for the inflation target being at 2.5% is that if you adjust for technology and quality improvements over time, that 2% kind of adjusted for that is, you know, is a reasonable target to be set at. So we're a long ways from that. It's difficult to see us being near that 2.5% by the end of the year unless something happens fairly dramatically. 1/3 of the inflation has been housing, because if you think about the basket of goods that people buy, the housing rents are, well, they're weighted in here at about 1/3. So to the extent that rents and housing prices decline a little bit, but in particular rents, then that's going to help bring inflation down. This is the Case-Shiller housing index, and there's the recent numbers would indicate that maybe there is a bit of a downturn in the housing prices, and maybe there's enough housing starts, especially in multiple family housing out there, to start to bring this down over time, and that would certainly help with the inflation. On the other hand, wage growth continues to be strong, and this certainly has a lot of economists concerned, because a lot of people remember what happened in the 1970s in particular, when there was a kind of a wage price spiral that got out of control and took a long time in the early 80s to bring it under control. On the other hand, if you look at this graph in particular, you can see that there was a long period there, particularly between 2010 and 2015, when wage growth was really sluggish. And so maybe part of the story here is catching up, and that's not necessarily the worst thing. But to the extent that people are fully employed and wages are rising, then that makes it more difficult case to see how we're going to bring prices back down. And so that's, the Fed is certainly concerned with that. The other thing is that the Federal Reserve raising interest rates is a very blunt instrument. And so kind of turning that thing and not overdoing it is a pretty tough call, and it will be interesting to see how they can get this right to get what they want, which is the so-called soft landing, which is that we bring that inflation under control without ratcheting down so hard on the economy that we cause a recession. This, I'm sure you guys are probably familiar with this, which is this is the 10-year bond rate minus the 2-year bond rate. And the reason I put this up here is that this is one of the leading indicators historically of an impending recession, which is to say that the 10-year bond rate should be above the 2-year rate, right? Because you should require a higher rate of return to lock your money in longer term. You do a 2-year bond rate at a higher one, you've got the option value afterwards to either reinvest in another 2, for example, or do something else with the money. So generally we would expect this to be positive. You can see most of the time it is positive, right? And so, however, historically these gray vertical bars are recessions. So this goes all the way back to 1980. You've got 6 recessions on there since 1980. 4 of them being pretty brief, and a couple of them being longer. In particular, the one in 2000 that started in 2008 went for 18 months. But in each case, this 10-year minus 2-year went negative prior to it. And so, and on this graph here, on the 4th of July in 2022, it went negative, and we've been negative since then, maybe coming up a little bit recently. But this would indicate that we might have a recession in the future. I will say that if you look at these ones in particular, that this 10 minus 2-year went negative between 12 and 18 months before the recession actually happened. So by that measure, if we were thinking that this was going to indicate a recession, it would be sometime between July and December of 2023. But again, it's real difficult at the current time with the full employment and the wage growth that we've seen to see how we kind of tip into recession unless things really turn fairly quickly. So let's get back to the dairy market, because you didn't come to listen to a dairy economist talk about the macroeconomics here. This is actually the last 4 recessions. So you can see one in 1990-91 triggered by oil prices. You can see peak unemployment went to 7.8%, GDP declined 1.4, lasted 8 months. Then in 01 we had that tech bubble burst, which is getting to be quite a few years ago now, but I remember it pretty clearly. 6.3% unemployment, down 0.3%. That was pretty mild on GDP. Then we've got the Great Recession, which was the housing mortgage crisis was the trigger. That was 18 months long. We hit 10% unemployment, and GDP went down 5%. And then we've got the COVID one, which only lasted 2 months, in large part because there was a massive stimulus, a couple of massive stimulus in there. But we did have peak unemployment of 15%, and GDP did decline by 20% for a short period of time. And the reason I put that up there is, in particular, one thing that comes with the recessions is less eating out. That has fairly big implications for dairy markets as far as when people go out, they are much less likely to drink beverage milk and more likely to drink at home. So I compared non-recession to recession years here as far as what happened to consumption patterns. And, unfortunately for the dairy industry, beverage milk consumption's been going down pretty much like clockwork for quite some time. However, recession years, when people go out less, they drink more milk at home. And it shows up. It still goes down, but only by half as much. And cheese consumption actually is higher when people eat out. They're more likely to eat things that have cheese on them. Butter consumption is higher when people go out, and yogurt consumption does the reverse. It's higher when people stay home. So, to the extent that we do have a recession, and I'm certainly not predicting that, it's difficult to see how it could happen anytime soon, at the earliest by the end of 2023. But if we did, it would certainly matter where, what products and where they were being sold as far as what it would do. But that's part of the uncertainty that's hanging over the dairy demand here for 2022. The second part is the kind of the international markets. This is specifically China, and these are in metric tons, million metric tons. So this is beverage milk, whole milk powder, skim milk powder, cheese, and butter. And then the top row of numbers there is how much did China produce in 2022 of each of those products in million metric tons. The second row is how much did they import, but not just from us, but from anybody. And then the third row is how much was consumed. And then the bottom row is the percent that was imported. As you might expect, fluid milk is bulky. It's 87% water. It's expensive to haul. And so China produces 97.5% of their beverage milk consumption. They actually don't consume much beverage milk. A lot of Chinese people have issues with the lactose, and it's not necessarily something they consume a lot of. However, they have been in recent years consuming a lot of what they call milk tea, and we call bubble tea here, which is milk and tea together. And that actually, with young people in China, has been a source of a lot of beverage consumption. And China's been intentionally increasing the amount of milk that they produce, trying to meet kind of their domestic market. And they're not quite meeting, certainly, their fluid market, but it's close-ish. Whole milk powder, which they're using a lot to supplement and also for infant formulas and things of that nature. They're importing 42%. But then you look at the skim milk powder, the cheese, and the butter, and again, they don't consume a lot, but they produce almost nothing of those products. And so they're importing 88 to 93% of those. And why am I talking about China so much? Well, when China imports a lot of dairy products, particularly from us, it certainly is highly correlated with high milk prices. So actually, our dairy export volumes were actually down just a little bit to China in 2022 over 2021, but the value was way up because the prices were higher. And we, European Union volume to China was down by almost a third, and we filled part of the role there. If you look at the global dairy trade to China, you'll see there's kind of a trend like clockwork, but there's two humps in there that really stand out. One of them was 2014, and the other one was 2021, 2022, and it's not an accident that those are the two highest and most profitable milk price years that we've had in the last decade. When China is in the market big, they're enough to tip things on the international demand and to bring everybody's price up. So, why do I bring this up? Well, as you heard about in the news, with the big opening from their zero COVID policy, there's some estimates that say, 60% or more of the Chinese population has had COVID or, recently or has it currently. And so what's that going to do to their spending? What's that going to do to their economy? What's that going to do to their income? China, if they're going to be in the dairy market, it needs to have, a growing economy and the ability to spend the money. So we're kind of all waiting to see what happens there as far as what that does to international dairy prices, and to the extent that they're not importing as much because they're staying home because their GDP is down. The other thing China is dealing with that we're kind of watching, right, is what happens with what everybody seems to all agree is quite a large housing bubble price. And so whether they can unwind that without really damaging their economy is going to be a big part of whether they're involved in these international markets and stuff. So we're watching that. Then on the supply side, we get into where the cost of production has been. This is the Dutch natural gas price, which I think that's yesterday's price, 48.90 euros per megawatt hour, which is, first of all, lower than we were before we hit the before we had the Ukraine crisis, which drove most of that big spike that we had in 2022. And then this is a headline from the other day, which is Dutch natural gas use drops to the lowest in 50 years. So the Netherlands actually used 25% less natural gas in 2022 than they did in 2021. So, the prices got high. They were concerned they wanted to wean off of the Russian natural gas. And so they all, I guess, are taking a whole heck of a lot of cold showers and keeping the heat low on their houses. And it was very fortuitous that there's been a relatively mild winter, not just here but in Europe, right? Because this has been maybe a little bit easier than it would have been otherwise for them to lower their natural gas use. But why am I talking about natural gas? Because, well, natural gas is the kind of very highly correlated with the price of nitrogen fertilizer, right? And so when we had those high natural gas prices last year, that certainly drove up the fertilizer bill of everybody that hadn't had it prepaid. On the other hand, going down here also means if you did prepay, maybe you could have gotten it cheaper later. So part of the question I have is how much of that fertilizer bill is prepaid this year. This is the fertilizer price index for North America. And the most recent number on here, and this is an index, is 541. You can see this goes back for 20 years or more. And so you can see quite a big spike there in 2022. But we are now back to the fertilizer price levels for North America on average of where we were 2 years ago, which are not low fertilizer prices historically, but they're not, nearly where we were. And so what's that doing to planting intentions? What's that doing to the acres of corn that we're going to put in this year versus soybeans is, I think, a big part of what's going to be driving the cost of production for milk here for this next year. And so we're all watching, and we're also watching, by the way, the yield in South America. Another factor on the crop side, and to a lesser extent on the animal side for milk, is that we've had La Nina for the past 3 years. And, El Nino, La Nina refer to where the jet stream off the Pacific moves, basically kind of how far north does it go. And so we've been in the La Nina we're now into the 3rd calendar year of a La Nina. That affects the weather, the precipitation, the heat, the temperature in many parts of that are major dairy producers. Right now, and this is as of this last week, we're supposed to move to neutral conditions within the next couple months, certainly by the middle of the year, which would mean we don't have either an El Nino or a La Nina. It's neutral. And if that's the case, then that will have implications for kind of how much rainfall and how kind of what the growing season looks like in North America. When it's La Nina, like we've had the last 3 years, that leads to drier conditions, particularly in Brazil and Argentina and New Zealand. And so Brazil and Argentina, that matters because they've had poor corn and soybean crops, which has led to lower world stocks for the last couple of years. And I think they're supposed to have, the current crop is not looking great either from what I've read. New Zealand, it's affecting their pasture quality. And then it ends up being colder and stormier in the northern United States and more hurricanes off the Atlantic. So if we move to a neutral one, then we should get more precipitation in Brazil, Argentina, New Zealand, maybe have less hurricanes and less colder, stormier weather in this part of the country. The bottom right figure here is the most recently, from a couple days ago, released U.S. drought monitor. And you can see that there's a reasonable amount of drought in Kansas and Oklahoma and some parts of Texas and Nebraska. But relative to the one in the upper left, which was 6 months earlier, there's certainly not the current drought conditions, particularly in California. And we've had a lot of big storms in California. The good news is a lot of those storms were snow in the Sierra Nevada, which have put a lot more snowpack in there, which will hopefully melt slowly. It's hard for California to capture the big rainfalls, and a lot of it just ends up running back out into the ocean. But the snowpack melting and running down is the best way to store it there. And maybe that means that there's going to be more water available for growing crops in the Central Valley, which is good for those guys. Maybe not so good if you're competing with them, because that's going to bring their forage costs down and certainly make it a little better margin out there in California to the extent that it continues. So that's something to keep an eye on. Butter stocks for 2022 is the black line. You can see how much lower the black line is than the previous 2 years. That was the major driver, a major driver of those high class 4 prices that I had at the beginning of the presentation. Right now we've got 216 million pounds of butter in stock, and which is not high historically. However, the fact that the December number jumped by 8.6 year over year was one that put a little damper on butter prices here most recently. So we certainly don't have a ton of butter stocks relative to historic and stocks to use numbers, but there is concern that that number built in December. And so we'll be watching that with the new stock numbers that are coming out here before too long to see if we are really starting to build some butter stocks. Cheese stocks, we've got 1.45 billion pounds of cheese total in stocks. To put that in perspective, that's about a month's worth of production nationally across all types of cheese. So that's not a huge amount of cheese. You can see that the cheese stocks were higher though throughout 2022 than we had been, and that's put kind of a damper on the cheese market is certainly going forward. And there is concern with the added capacity we've had with some big new cheese plants, particularly in the southwest part of the country, that we're going to need to export more, or those stocks are going to build. This is cheese production, and you can see 2022 was 1.8% more cheese year over year. That was when milk production was only up 0.2%, right? So we've got relatively more milk going to cheese, because you can't build a big new cheese plant and not run it. You can't spend, the big new cheese plant is going to cost $500 or $600 million, or maybe even more. And so those come with long-term contracts. And so we are producing more milk is going to cheese, and part of that is taking milk away from butter production, and that's why butter production kind of lagged, even though the prices were high in 2022. If you break it down by type of cheese, American cheese production, which is cheddar and those types, that was flat, and the increase in 2022 was in Italian cheeses, in mozzarella and other types of Italian cheese. So everybody go eat pizza, because we need to keep the consumption increases going in that area. But certainly the concern is that we're going to build stocks, and that's kind of overhanging the market at the current time. If you look for 2023, this is USDA's forecast for 2023, that New Zealand milk production be flat to slightly lower, and that's off of a year that was slightly lower. So if that's the case, then New Zealand won't be pushing into new markets too much on the export side. For the European Union, the forecast is for them to cut back on cattle numbers, in particular in the Netherlands, because of the environmental rules that are going into effect there. And if that's the case, then there will be a decreased amount of milk production. However, countering this a bit are those numbers I threw up there earlier, which shows that the milk production was up in December year over year because of the extremely high milk prices. And one thing that dairy farmers are good at is figuring out how to make milk. So that will be something we'll watch and see whether the European Union actually is kind of down. The most recent number is that U.S. milk production up 0.7, 0.8% in 2023, with weaker milk prices and lower cow inventories, and exports expected to shrink. It will be interesting to see if that holds true. I don't know that I would expect overall exports to shrink, but we'll have to watch. And prices lower because the cheese stocks remain large. That's that 1.4, 1.5 million pounds of cheese. This is where the class 3 and 4 futures markets closed yesterday. Class 3 is the red. And this is by the way, this is a very typical annual pattern with the low milk prices in March and the high milk prices in October. And that's certainly what the futures market is predicting here, which is that we'll go into spring here, coming out of the holiday purchases and starting to build stocks, and that will keep the milk price down. It's got class 3 at about 17.60 in March, and then about $20 in September, October. And class 4 now predicted to be above class 3 for for the entire year, remaining year of 2023, going from about $18.75 to about $20.25. This is the March contracts over the past 4 months. The reason I put that up there is for two reasons. One is that you kind of can see the 3 months trend downward as milk production recovered in the second half of 2022, and as maybe we started to build some stocks after the holidays. But then you also see that in the last month they've diverged, where class 4 has climbed a little bit and class 3 has continued kind of its downward trajectory because of the cheese stocks. So here's where USDA was for the February World Ag Supply and Demand estimates. 2022 average corn price for the United States is $6.77, and 2023 it's $6.70. So they're forecasting on an annual basis for the corn price to be essentially unchanged this year. That will depend a whole lot on how many acres get planted and what the crop year ends up being like and what the final numbers out of Brazil and Argentina are. But that means, if that were the case, that the feed costs are unlikely to get a whole lot cheaper. Soybeans at $14.88 for 2022 and down about 60 cents a bushel. And they've got soybean meal at $4.50 next year for 2023, which is in the neighborhood of where we are right now nationally. All milk price, on the other hand, goes from $25.55 to $20.70, and that's down, by the way, 60 cents from a month earlier. It was at $21.30 in January. And so they are continuing to think that the milk prices are just going to languish in 2023. They're concerned about kind of the demand domestically and consumption. You can see class 3 prices were about $22 there in 2022, and down $4, and class 4 prices down $6 on this as far as the current forecast. So if milk prices stay the same, if feed prices stay the same, but milk prices decline by $5 a hundredweight, that is certainly going to indicate that it could be a very stressful year financially on dairy farms. It's a little bit hard to kind of make those two jibe, although it is true that it does take milk production a while to respond sometimes to the increasing cost of production. But if those feed costs stay there, I would be hard to see milk production increasing much, especially in a world where we still have those base programs applying lots of places. And really the next big number for USDA report is the prospective plantings report that's coming out March 31st, which is going to be a big one in determining what happens with the corn and the soybean prices. This is where corn closed yesterday, $5.93. So we've got $6.70 forecast for 2023, but that's because it's higher at the beginning of the year, and this is harvest number for 2023. But still, that's not a dramatic decline, and that's because the USDA is not actually projecting much of a build in corn stocks at all. And so it will really depend on how big a crop it is, how many acres get planted, and kind of what we end up exporting and using for ethanol and things of that nature. But this would indicate feed prices are actually not going to come down a whole lot. Here's the actual dairy production margin that is used in the dairy margin coverage program. and is a reasonable indicator of profitability. The dashed line is where the market is currently forecasting it. If you participate in the dairy margin coverage program, you could protect at 950, which is one box down in that yellow area. And the dairy margin coverage program is going to pay if you're signed up at 950, which is what would make the most sense. And it's going to pay well, but it's also capped at only 5 million pounds of production, which is only 225,000 pound cows. So to the extent that you're bigger than that, then there's other places to look for risk management. And this is where this figure here comes from, which is to say, this is using the futures markets, forecasting the all milk price in the first column, the corn price, the alfalfa price, the soybean meal, and then the margins. And you can see we got margins in the $6 and $6.50 range for February, March, April, May, which means that the dairy margin coverage program is going to be paying, to the extent that that's correct, $3 a hundredweight on that amount of milk. And those are pretty darn low numbers. We got an average there for 2023 of below $8. We'll see. And then this is just using Cornell Dairy Farm Business Analysis data. I just was looking at how good that income over feed cost margin, which is this margin here. Okay. So when I say IOFC, that's the actual dairy production margin. Same thing, income over feed costs versus rate of return on assets, so a measure of profitability on the New York farms. And we don't have the 2022 numbers in there yet. My read from what I've been seeing and talking to is that 2022 was a pretty good profitability year on conventional farms and not a very good profitability year on organic, because the feed price risk and feed costs just got kind of outrageous on organic dairy farms if you had to purchase anything. But historically, these are pretty well correlated, a correlation coefficient of about 80%, 0.8 on these. And so, we should see that coming up. But this also indicates that income over feed costs is probably a pretty reasonable measure for risk management purposes. And then let me just really wrap up here. We're looking at a farm bill that's going to be expiring at the end of the year. We're going to be having discussions about that. And part of the discussion on the dairy side is going to be, are we going to make any changes to the dairy margin coverage program? That probably depends on whether we have any baseline. And then maybe the second half of the year, we're looking at a federal milk marketing order hearing type thing. So I think I've taken all my time there. I would be happy to try to answer any questions.
Great, Chris. Here, so let me share my screen real quick, just so everybody can see where we're going. Great. So I think one of the first questions I think we're going to get to is, so Chinese imports get all the attention, but can we export much more in dairy into Mexico? Any thoughts on that market?
Well, to the extent that Mexico, especially as their income increases, to more that Mexico becomes a middle income country and less of a lower income country, there absolutely is the opportunities to export more cheese, I think, into that market. And we have been moving from exporting lots of powders, which are relatively lower value, although they're still important, to higher value products like cheese. And we've actually been increasing our production of kind of Mexican type cheese in this country. Mexico is not a great place to milk cows in the sense that the weather is not great, and it's also hard to grow energy crops there, in particular corn. So what, I think there's room definitely to grow into Mexico. And actually the biggest constraint probably into exporting into Mexico is the free trade agreement that they have with New Zealand now. But if New Zealand milk production's down, then they're certainly not going to take more share away from us. And we do have an advantage with logistics to getting things into Mexico.
Great. So certainly milk prices will be lower this year than in 2022, and there is uncertainty as how to much. Do you see this as a more upside price risk or more of a downside price risk?
I think there's certainly some. Well, you could make that case either way. there were some opportunities a few months ago for the second half of the year that looked pretty good for risk management. There's certainly downside risk in the second half of this year relative to where the futures markets are now. It's hard for me to jibe USDA's milk price forecast with their feed price forecast. If that's the case, it's going to be a really, really difficult year. We are going to have we're going to get a look at how many herds exited here this next week when USDA puts out their licensed number of licensed operations. And my sense is that in some places we're going to be pretty surprised at how many people went out. So given that it was a good year, and I think part of the story was that some of those operations that had been considering whether the next generation was going to come back or not thought in 2022, well, here's a pretty decent year. Maybe this is the time to sell. So, we'll see. I think USDA is underestimating the milk price, but yeah.
Okay, so kind of keep going along the same line as people entering and exiting the market. How do you think those USDA numbers are going to look, especially for the Northeast, in terms of people? How many do you think we're going to see a decrease in operations?
I think we're going to continue the long-term trend of the small and medium-sized operations exiting, but I think it was probably, like I mentioned earlier, unfortunately, I think it was a real hard year from some of the organic guys, and I think that USDA won't break it out that way, but I think in a relative sense, more of them have either exited or under extreme financial distress, and but really, I think you're going to see in the states like Pennsylvania, Wisconsin that still have a lot of dairy producers. I think the numbers are going to be pretty decent number of exits there.
Okay. So any additional thoughts on other risk management tools at this point?
Well, I mean,
or I should say, what do you think is the best course of action for this upcoming year?
Well, okay. I've kind of always thought that, step one, get a handle on your cost of production. Step two, look at what you've got locked in for feed costs, where you're at, particularly on the forage side, how much of your grain you've got prepaid and what that looks like. And then, you go look at dairy revenue protection at this point, for example, is where I would start. And what are the opportunities, particularly between 6 and 15 months out, and what does that look like relative to my cost of production and what I have locked in? And to the extent that you can manage that income over feed cost margin that way, I think there will be opportunities out there, and there certainly were in recent months. But I've always been in particular fond of that being 9 to 15 months out, kind of consistently. And so, and sadly, you're probably thinking, well, that doesn't help me a ton for 2023 because 9 months out gets us into November. But there'll be some opportunities in that 6 months out one. Shorter than that is a little harder to make it work unless something dramatic happens, which is possible. One thing about the futures market is it's a really good, unbiased, efficient estimator of these prices, but of course can't predict big shocks either way. But there will be opportunities on the risk management side, and there are at the current time, some opportunities depending on what your cost of production looks like, and that's the first step.
Great. So I think as we wrap up here, because I think we've answered all the questions that have came in, what are 2 to 3 takeaways that you would want to give before we all sign off today?
Well, I think the big one is watch your feed price risk. It's going to be a tight year, and hopefully people exited 2022 with a reasonable amount of liquidity, and can make this work, because we will. Long term, the forecast I think is still real healthy for the industry, particularly in this part of the year, part of the world. We've got forages, we've got water, and we've got proximity to the major metropolitan areas that are the markets. So, I still think the dairy farmers will figure out a way to do well in this part of the world.
Great. So again, Chris, we really appreciate you taking the time to speak with us today. So as a reminder to everybody, all of our webinars, past, present, and future, are on farmcrediteast.com/webinars, as well as our YouTube channels. So with that, I wish everybody a great Friday afternoon.
Thank you.